Hello everyone, welcome to our video. In this video we will talk about the mechanics of futures markets. So let's start. So first of all, the futures contracts are available on a wide range of assets, and these contracts are traded in organized exchange. In an organized exchange, we can find such exchange globally in many different countries. And each contract need to have certain specifications. These should be defined in advance. For example, what is going to be delivered, where it can be delivered, when it can be delivered. See, these are some examples of these specifications. And these contracts, they are settled daily. There is something called as the margin, and this is the cash or marketable securities that are deposited by an investor with his or her broker or investment house that he has the futures trading account. And in order to conduct this futures trading, you will need to keep this margin account in your broker's company, and the balance in the margin account is adjusted with respect to the daily settlement. So based on every single day's trading day's profit or loss, this will be reflected in your margin account, and this allows the futures trading to minimize the possibility of a loss through a default on one of the parties in a futures contract. So here's an example. Suppose an investor takes a long position in December 2nd gold futures. Okay, so as you see, the contract size is given as 100 ounces of gold that is going to be delivered. So if you are taking a long position, that means you agreed to buy the given size of the gold at the specified agreement price at the maturity date. Okay, and suppose the futures price is 600. That means you agreed to purchase this 100 ounces of gold from $600. So each exchange will have its own rules in terms of the margin requirement. So these margin requirement, let's say, is 2,000 per contract. And if you are taking a long position, in other words, you promise to buy 2 contracts at the June 5th as the maturity date, then you will need the 4,000 in total to be deposited in your margin account, so that the default risk is minimized by the help of this margin account. And there is also something called as the maintenance margin. And suppose the regulation is 1,500 per contract, which gives us $3,000 in total. So every single day, once we enter the contract, let's say on June 5th, and suppose this is the December contract, every day the price of this futures contract will change. For example, you can see 597. Let's say initially the price is 600, and at the end of the close price on June 5th is 597. So this means since we have a long position in 2 contracts, and each contract is written on 100 ounces of gold, so $3. And remember, we have a long position, so you can think like we are just purchasing this asset from 600, and if the price went down, we are going to have a loss, and the difference is $3 decrease in the price of this asset. And notice that each contract was written on 100, so 2 contracts we have 200 ounces of gold that we promised to buy. So if the price went down, right, we agreed, since we agreed to purchase this gold from 600, we have a loss actually, because the spot price, the new futures price went down to 597. So what's our loss? Our loss is 3 times 200, because the price went down by $3, times 200, you get $600 as the loss. And then here you can write the cumulative loss. And at the end of each trading day, suppose we have this initial margin account as 4,000, right? Remember from here, margin requirement is 2,000 per contract. And therefore now, since we made a loss of 600, our account is reduced to 3,400. And as time goes on, each day you will see the price is changing for the futures prices, just like the spot prices. And then you will calculate what's the difference from the last price, and then we will multiply that by 200 ounces of gold. So for example, now from 600 we went down to 593.3. So this is 6.7 times 200. This is your cumulative loss so far. And remember, this is deducted from 4,000. That gives you 2,660. Suppose this is the first time we went below $3,000. And remember, this was the maintenance margin for 2 contracts. So whenever we fall below this 3,000 level, we are going to get a margin call from our broker house, and they will ask for adding cash to bring this number back to the original 4,000 as the margin requirement. So you will need to add this 1,340. You need to add this additional cash in order to continue trading, to continue to hold your position. I mean, if you are not able to pay this, then you might be forced to liquidate your positions, and then that will be deducted from your futures position. So you might be forced to liquidate your long position by by taking a short position. So as time goes on, you can see that the prices change. I mean, once we are back to 4,000, again, the first day, once we get to the close price, let's say 587, if the price continue to went down one more time, then again one more time we are below this 3,000 threshold, we will get the margin call. Okay, margin call will be received whenever we are below this 3,000 level. And again, the remaining part from 4,000, this will be now our margin account is 2,740. Then we will need to add this amount to fill it up to this 4,000 level. And basically on each trading day, this profit and loss will be deducted or added to your margin account. And whenever you fall below the maintenance margin level, then you will receive the margin call. And at that point, you will need to make sure you have the initial margin requirement satisfied for the given number of contracts. So this is the mechanism in the daily settlement that is applied in the futures markets. And notice that you can actually close your position. You don't have to wait until the maturity date. If you take the long position, let's say on June 5th in the open, when the market opens, then you can close this position on June 26th by taking a short position to cancel basically the existing long position. So there are there are a few key points. So we mentioned these futures contracts are settled daily, That's an important property. And if, as I mentioned, if you want to close out an existing futures position, you will take an offsetting trade. Here, if you originally have a long position, the offsetting trade will be taking a short position to close your long existing positions. And remember, most contracts are closed out before maturity, because if you are not interested in the physical delivery of this product, then you will need to close out before the maturity arrives. And these there are also OTC markets. Basically, these contracts can also be collateralized in the OTC markets, and then they are similar to futures contracts in that they are settled regularly, and every day or every week we can have this. And the futures prices increase with maturity. That's because the time value of money, if we have the risk-free rate as a constant, then basically we will see the prices will increase with respect to the maturity of this contract. And we can also say on the inversely, the prices will decrease with maturity as well. So there are a few issues about the delivery. If a futures contract is not closed out before maturity, this is settled by delivering the asset underlying this contract. And all these specifications about the delivery are specified, and basically they are defined by the exchange, and certain rules are announced. So you will need to fulfill these requirements if you are going to do a physical delivery of this underlying asset. And there are also some futures contracts that have the cash settlement. So these are settled in cash. And finally, there are a few terms that we need to introduce. First one is the open interest. So this refers to the total number of contracts outstanding in the market for this specific asset, and this is equal to the number of long positions or the number of short positions. And then we have the settlement price. This is the price that's just before the closing bell, and this is used for the calculation of your profit or loss at the end of each trading day. So this is what we refer as the daily settlement process. And then there is the volume of trading. That refers to the number of trades in one day. And then we need to know that basically the futures prices and spot prices, as we get closer to the maturity time. So here you see we have the maturity. This can be, let's say, denoted by maybe capital T. As we get close to this maturity time, these prices will converge to each other. We can have the futures prices above the spot price, or we can have futures prices below the spot price. But in both cases, as we get closer to the final maturity, these two prices will get closer and closer to each other as a requirement from the no arbitrage condition, because otherwise there will exist some arbitrage opportunity if they don't converge to each other as we get very close to the maturity. So some potential questions you can also think about. So when a new trade is completed, what are the possible effects on the open interest? The second question is, can the volume of trading in a day be greater than the open interest? And regulation, of course, is important, but we are not getting into the details of the regulation. And basically, obviously, the main purpose in regulation is to protect the public interest and avoid a systematic risk or default in the exchange. And there are various mechanisms to avoid systematic risk. There are also some accounting and tax issues. These are also specific to country by country, so we can skip that. And fundamentally, you can compare and we can emphasize some differences between the forward versus futures contracts. So in a forward contract, this is what we refer as the contract between two parties. In the futures, these are traded in the exchange, and these are standard contracts. And in the forward agreement, you have more flexibility. They are not standard. Also, delivery date can be in a forward. The delivery date is flexible, but in the futures there are fixed and there are several standardized delivery dates that are available. And as we have discussed, daily settlement is important. It's an important difference between the forward versus the futures contracts. And delivery or final cash settlement usually occurs in the forward contract. So it's more likely that you wait until the maturity if you have a forward position with another institution. But in a futures contract, it's more common to close out the position before the maturity. There is some credit risk in a forward contract, and we have virtually no credit risk in the futures contract because the exchange takes some precautions to avoid the systematic risk. And one of the popular futures contracts is the FX rates. These are quoted as the number of USD dollars per unit of the foreign currency, and forward exchange rates are quoted in the same way as spot exchange rates. So, for example, British pound, euro, Australian dollar, or New Zealand dollar are quoted as US dollars per unit of foreign currency. And other currencies such as Canadian dollar and Japanese yen are quoted as units of the foreign currency per US dollar. So regarding these, there are different, as you see, conventions to represent these quotations. But these are just for convenience and to make the quotations more readable by the investors. Okay, that's all for this video. Thank you for watching.